This conference will now be recorded.
Okay, here we are in week 6 with our last real lecture before the midterm. I will have a review lecture in week 7, but this lecture is kind of wrapping everything up on the 1040. It's gone pretty quick. In week 4, we looked at income and deductions, and then in last week we looked at itemized deductions. And now we're ready for the final piece, credits. These are a lot of times the most important items because they can really reduce your tax liability. And I wanted to give you an upfront example to show that, what I mean. When you talk about taxes, when you deduct money from what you owe, it's either going to be an adjustment or a credit. An adjustment simply takes off of your income, but doesn't take off necessarily on your tax bills. It'll reduce the amount of income you pay tax on, but not the actual dollar amount that you owe, where credits actually deduct dollar for dollar off of your tax bill, not just what your income is. So look at this example. I have the same situation. We're going to do it 2 different ways, looking at the difference between a $5,000 adjustment from taxable income, like this would be in those items that were student interest deduction, or even potentially adding 5,000 on as an itemized deduction would be the same thing, or taking a $5,000 credit. So if you do option 1 and you take the adjustment, 5,000 off your taxes, you would go from 30 to 25 as your taxable income. Then we would look in the back of the book in our tax tables for married filing joint with taxable income of 25,000, and you'll find that the person will owe 2,622, $2,622. All right, let's look at it from the other point of view then, doing a $5,000 credit instead of an adjustment. So with the credit, we don't take anything off our taxable income. We're going to figure up our tax on the full 30,000. So you can see if you just compare these two, this is how much money you saved by doing the adjustment, which roughly is $600 or so, $600 you're going to save. If you do and that's with taking a $5,000 adjustment. If you take a $5,000 credit, you're going to save all of the money. You don't pay any tax, because if you tax yourself on 30,000, this is how much you owe. With a credit, you can take dollar for dollar off of this amount. So you can take up to 5,000. We don't have even that much, so we can't go below 0 with normal credits. So it's going to take us down to owing nothing. Whereas up here, we still owe 2622. So we saved a lot of money. If there ever was a time when you could decide, do I want to take an adjustment or a credit? Almost every time the credit's better. Now, when I said you can't go below 0, that's what's called a non-refundable credit. And I've got a whole list here of non-refundable credits. But there are some credits that are even better than just normal credits, and those are the refundable credits. These refundable credits give you money back over and beyond what you owe. So you can actually go below 0 and get a large refund. And the primary way to do that is with the earned income credit, with the additional child tax credit, and then the American Opportunity Tax Credit. These are the 3 primary credits. Besides actually getting back what you paid in, you get all that money back too. But those are the 3 primary ways to get money over and beyond what you owe. We're going to kind of look at them, the refundable, non-refundable in step. I'm going to try to do most of the non-refundables first, but as you'll find, especially when we talk about the child tax credit here first, it leads right into the additional child tax credit. So we kind of do those together. The regular child tax credit is non-refundable. However, you are allowed an additional piece that is refundable.
UPS dropped this off for you, sir. Where would you like it?
This conference will now be recorded.
All right, I was interrupted by a delivery, but we're back here. Okay, with the child tax credit, non-refundable, can't take your tax liability below 0. And what where you're gonna find these is what I would highly recommend is having your a 1040 open. I think it's best to visualize where things are going, and so you can see it instead of just me hearing about it. If you turn in your book to page 2-3, this is probably the best place, because on the next page over, 2-5, it has the non-refundable schedule, schedule 3. If you look at 2-3 though, where we're looking at for non-refundable credits is down there on line 12. The child tax credit and then credit for other dependents, and then add any other from schedule 3. Now this cannot take you below 0, as you can see in line 13 on the 1040. You're going to subtract line 12 from 11, and then it can't go below 0. So the first one we're talking about is on schedule 3. Actually, it's not even on schedule 3. It's right there on the 1040. 12A, the child tax credit. With this child tax credit, you can take, which is brand new, the amount here, $2,000 per kid. It used to only be $1,000, but with the new tax overhaul this past year in 2018, it's now up to $2,000. Now the rules didn't change. You still have to be, your kid has to be 16 and younger. So even though you may claim your child as a qualifying child, not every child allows you to take the child tax credit. They have to be 16 and younger. And basically what this is the child can begin to take care of themselves financially at about age 17. They can go out and start working. All right, so the phase out, this has really gone up as well with the new tax overhaul, 400,000. So your AGI can be really, really high, 200,000 for single or head of household, and you're still allowed to take $2,000 per kid. It gets to be if you do happen to hit this amount, notice the amount is only $50 per 1,000 that you're over. So what that means is if you have income of $401,010, you are 1,000 over for sure, and then that next 10 is a part of the next 1,000. So you're actually going to be considered 2,000 over. So therefore 50 and 50 would be $100 reduction that you would have to take off on your total credit. It's not per kid, it's the total amount of credit. So if you had 2 kids, you could still take $3,900. All right, let's look at my 2 examples. We got 3 kids that we are claiming as qualifying children. AGI of 90,000. How much can this couple take as the child tax credit? And then go ahead and do the second one with the AGI being up to 405,100. So go ahead and pause, and then I'll go through the answers. Okay, with the first one, the AGI doesn't come into play. The only thing that comes into play is this 17-year-old doesn't count. So we can only take 2,000 for the 12 and the 15-year-old. So that would be a total of $4,000 that we could claim right there on line 12 of the 1040 on 12A. For part B, we are over by 5,000 and then another part of, so $6,000. We are over the limit. So there's 6 parts. So $50 per part. So 50 times 6, we're not allowed to take. So the amount of credit that would be allowed to this type of couple would be $3,700. Because remember, it's for every 1,000 or part of, that's a separate unit. You have to take $50 off. And we are over that by 6 parts. Of course, for the first 5, and then the next 100 counts as our 6th part. Okay, brand new for the year 2018 with the new tax overhaul is, instead of having what's called a dependency exemption, where you take off income, you actually get a credit. So remember how we had talked about, is it better to have a credit or a deduction? In the years past, you got a deduction for, it was about $4,000, give or take. It would go up slightly every year, but it was about $4,000 for every dependent you had, including yourself. Now, the good and the bad. The bad is you no longer get a deduction or a credit for yourself or your spouse. You do, the good is, or you don't get a deduction for your dependents. But the good is, for any dependents that you have other than the children are the best because they get $2,000 off. Any other dependents that you claim besides you and your spouse, you get a $500 credit. Now, this is scheduled to go away, but I'm guessing it will be extended beyond the year 2022, but we'll see when that comes. So this, again, is designed as a workaround as the personal and dependency exemptions were eliminated with this 2018 overhaul. Okay, so if it happens that you cannot take all $2,000 or however much you're allowed to take if you have 2 kids or 3 kids, if you can't take it all, there's a chance that you will qualify to get an additional child tax credit. And the reason you couldn't take it all is because if your tax liability got down to 0, if your tax liability was down to 0, you can't go below it. So get real quickly here, if you look back at the 1040, if your tax on line 11 would be $2,500, that's how much you owe, and you have 2 kids, you could only take on line 12A $2,500, the amount of the tax that you owe. You couldn't take all $4,000. However, that additional $1,500 that you're leaving behind, you may be able to take it here as an additional child tax credit. This is a refundable credit, the best kind. And the refundable credits, if you look at the 1040 again, they're down on line 17. 17A we'll get to later. It's the earned income credit. The 8812, that's the educational American Opportunity Credit. We'll get to that in a few minutes as well. And then finally, C, that's the one we're talking about right now, the additional child tax credit, Form 8863. Or excuse me, the 8812 is the additional child tax credit. The 8863 is the education. I don't expect you to memorize those, but they are the more common ones, so you may want to know these. Form 8812 is the additional child tax credit, which is 17B, and Form C, 8863, is the education. Now, so you can read through here, 70% of the child tax credit can be refunded. So that's up to $1,400. If you take $2,000 times 70%, that's $1,400. Now let's work through in this example C to see exactly how the additional child tax credit works. So what I'm going to do is I'm going to also pull up my additional child tax credit form. As that's pulling up, we've got 2 kids. Okay. Jackie has 2 kids, ages 10 and 6, so they definitely qualify for the child tax credit. They're 16 and under. She, got a little typo here. She is single and has a tax liability before any credits of $450. How much of the child tax credit and additional child tax credit can Jackie claim? Now, the reason I had that extra info in there is because I did need to state here what she had earned, and I had forgotten to put that in there. Let me see if I put it in this example. Nope. Let's just say she had earned a typical wage, maybe at $35,000, something typical. She earned $35,000. She's single and has a tax liability of $450. All right, so that $450, that's not going to take her very far. Let's work through and see how much of the additional child tax credit is she going to be receiving. So 1040 line 12A. Well, our line 11, she has a tax liability of $450. Line 12A, the child tax credit can't be anything above that. It has to stop at $450. Even though she could take up to $4,000, $2,000 per kid, but she can only take $450. So line 15, her total tax is 0. She doesn't owe anything right now. She's gotten her tax liability down to 0. And then now we're ready to fill out this form 8812. And here we go. I'll pull up the answers to show you how I filled it out. All right. So this is how the additional child tax credit works. It first off asks us how much would you have normally been able to take? 4,000. Line 2, how much did you actually take? 450. Okay, now the difference, how much do you still not have? The 3550. And then it says, okay, out of that 3550, you're allowed 1,400 per kid. You have 2 kids, so that's the most you can take is 2,800. So we're not going to be able to take the entire amount that we're going to lose, but we can take quite a bit. Otherwise, if there was no additional child tax credit, we would lose the entire 3550 and not be able to enjoy that. At least now we can take 2,800 of the 3550 we're missing. I put the earned income here as 30,000. You could put it as anything you want. 40 I put in there. It doesn't really matter. Anyway, if you take that, okay, line 8, we got 4,050. It tells us if line 8 is equal to or more than line 5, and it is, skip part 2 and enter the amount from line 5 on line 15. And that's what this would be right here. Line 5, 2,800. Oops. We would be able to take $2,800 as additional child tax credit. That's where I got the 2,800 from. You may want to go through that example again, and you can slow it down just to see how that form 8812 works. Okay, the child independent care credit. We are now looking at all the other refundable, non-refundable credits. So if you're looking at page 2-5 in the book, the next one we see there on line 49 is the credit for child independent care expenses. This is only available while you are working or looking for work, or potentially if you're a student, and I'll get into that in a second. If you're a student, it is allowed, but with a slight caveat. All right, so you're allowed a credit for a portion of the child independent care expenses. What that means is it's not a dollar for dollar credit. You get to use a certain amount of dollars that you spend, and then you have to multiply it by a percentage in order to figure out what the credit is. Okay, like with last week with the medical expenses, if you have money taken out for child dependent care, and you pay your child bill through flexible spending account dollars, you can't double dip. This only counts if you pay out of your regular checking account to the babysitter. It doesn't count if you pay through your FSA account. Some of the other rules here, the child has to be 12 and younger, or if they are incapable of self-care, then it can be any dollar amount. So people that are you're allowed to pay and still get a deduction or a credit, any type of daycare or caregivers, even day camps are okay. Even a payment to a relative is okay, as long as that relative isn't a dependent on your tax return. People who are not allowed, as you can see, the overnight camps, usually an overnight camp isn't there specifically for you to be able to work. Now, your credit is based on your AGI. And what I mean by that is, now if you turn in the book, hold your finger there on line page 2-5, we're going to come back. But if you turn to page 9-4, you're going to see the AGI credit amounts there at the top of the page. Anybody can take this credit. If you make even over $43,000, doesn't matter if you're married or not, if your adjusted gross income is $43,000, you can take up to 20% of what you spent in childcare, up to a limit. Now you have to have the taxpayers, the child care, whoever is sitting for your child, you have to have their name, address, and their identification, which is either their social security or their business identification number, because you have to have that in order to take the credit. Otherwise, you cannot take the credit. The reason is the IRS wants to be able to go back and check, did that person that you put down actually claim that income as self-employed income? All right, the maximum expenses. So you can't just pay an enormous rate of child care and then expect to take 20% or whatever your percentage is. You are capped at $3,000 or $6,000 for 2 or more dependents. Once you have spent, if you have 2 kids, once you've spent $6,000, then the rest of it, it doesn't matter if you spend another $1,000 or $10,000. You can only take the first 6, and then you take 6,000 times the percentage that you fall under on page 9-4. Now, one caveat here is the qualifying expenses have to be below or equal to the lesser spouse's income. So that means if you have one spouse that stays at home, you don't really need the child care, and the government's not going to give you credit for it because the spouse that stays home could be taking care of the kids. So that's why they say to the lower of this other spouse's income. So if the other spouse works part-time, let's say the other spouse only makes $5,000, then the most you could possibly claim as dollars that you used was $5,000. You couldn't use all 6 that you're allowed because the spouse only worked $5,000 worth. Now, the one caveat for a student, just because the spouse doesn't work, if they're a full-time student, key is here full-time, they are deemed, keyword here, deemed, not actually, didn't actually do it, but they are deemed for this purpose only to have made $250 a month or $500 a month with 2 or plus kids for every month they are in school, or partial month that they are in school. So if you're in school for the fall semester, mid-August through mid-December, you would get August, September, October, November, December, you would get 5 months. And if you had 2 kids, you would be deemed to have earned $2,500. And then that would be back up here, the qualified expenses. You could take up to $2,500 below the or equal to the lesser spouse's income. Well, their income would have been deemed of $2,500. So you could take up to 2,500 times the percentage on 9-4. All right, let's look at some examples. So we'll talk through D, and then you can do E and F. So with D, I want you to be able to determine how much. So you're going to pause here in a second. How much of the child care credit would this individual be able to take? So go ahead and pause. Okay, with this example, with each spouse making $25,000, so there's no issue with who is earning more or with the lower spouse not earning anything. They both earn $25,000. Qualified child care for 1 kid is $4,000. How much are we allowed to take? Okay, so the rule is you can't go above 3 for 1 kid. So the first thing is we can only have 3,000. And then we look at the AGI on chart 9-4, and we are over the 43,000. So we have to stop at 20%. So we're allowed to take 20% of 3,000 as a credit. And that would go on Schedule 3, line 49. Okay, go ahead and pause and do E and F, and then we'll go through these here in just a few seconds. All right, with E, we've got an AGI of 25,000. 1 spouse works, 1 spouse stays at home, and they use the child care center 2 days a week so that the second spouse can get the house chores done. Child independent care expenses are $4,000 for both kids for the 2 days a week for the year. Key with this is the one spouse makes the entire income, the other spouse makes zero. So with that being the case, you cannot take anything because the expenses cannot go over the other spouse, the second spouse's income, and the income there was zero. Now for our final piece, this deals with a individual who is a full-time student. So we have an AGI of 24.5, 2 kids. The one spouse earns almost all of it. So that means the second spouse earns only $1,500 in earned income. It tells us all of it is earned. But that other spouse who earns $1,500 is a full-time student for 9 months of the year. For their 2 kids, they have expenses of $7,000. So the 2 kids, the max that they can take is $6,000. So that's our starting point. We can't go over 6,000. What we have to be able to determine at this point is, did this individual make over $6,000 in earned income plus deemed income? So we've got $1,500 plus, remember they have 2 kids and they're in school for 9 months. So that's $500 deemed income for 9 months. 5 times 9 is 45. So 4,500 plus the 1,500, that does get us to $6,000. So we are actually right at the same amount, 6,000 as the allowed amount plus, and that is what the other spouse had been deemed to have made. 4,500 in school earned money plus actual earned income. And then the final thing is we need to look at our AGI. We're allowed $6,000 and 30%, because we are at 24.5. If you look at 9-4, we're in the 30% bracket. So therefore we get to take 30% off as a credit. Okay, maybe one of the most important parts, or at least maybe the trickiest parts of this whole section, is the education part. It's one of the trickiest, but it's also one of the most important as well. It wouldn't have to be as tricky if schools did a much better job of filling out their 1098-T. If you're a student, you have no doubt gotten a 1098-T in the past. These 1098-Ts, especially those from Ivy Tech, are of no use. You shouldn't rely on them at all. What you need to do is you have to go in and find your itemized bill broken down for every semester. That's what we're going to have to use to do any type of tax return, and we're actually going to do that. That's part of what I'm going to be giving you in some of the tax returns we do in this class this week. One big item that almost no students know, seems like it's a big secret, but if you get money back, and it's free money, meaning it's Pell Grants or scholarships, and you get that money refunded to you, it is actually taxable income. That needs to be added to your tax bill, and therefore you're going to get less of a refund, especially for state purposes. I've had at least 1 or 2 students every single tax year decide not for me to do their taxes because they did not like that rule and thought that I probably was wrong, and they would go to somebody else, and that's fine. But if you can go in and read anywhere in any IRS documents, if you look up refundable scholarships, they are taxable. And I need to change this. This is actually, it's included now in line 1, not line 7. That was last year in 2017, line 7. But this year it is on line 1. What I mean by the 1098-T being useless. Look at my little scenario here. So we scheduled classes for the end of 2018, and we were going to start in the 2019 spring semester, and our scholarship covers the entire amount. The tuition amount, we would get something in the 2018 tax year that says billed. Not actually are we using it yet, just that we signed up for classes, therefore they are billed in the year 2018. But nothing was received until 2019 for payment reasons. Therefore, if you look at the 1098T, box 2 is going to show when it actually, therefore, it appears to the tax preparer that the student had more payments in box 2 than they really did, since the scholarship did not get counted in 2019. So what it's going to look like is in 2018, for that 2018 tax year, it's going to look like, oh, you spent money. You spent $2,000. Well, not really. It's all going to be a scholarship covered later. But box 2 says, well, what was billed, not what was actually paid. So box 2 is going to say, ooh, you were billed, and somebody's going to look at that as, oh, you paid $2,000, and nope, no scholarships, so therefore you get a credit because you paid $2,000, which isn't true. So to get around that, to make sure everything is on par for where it should be, we need to look at an itemized copy of the student's expense records and their payments. So let's look at an example to show you what I mean. Okay, so we have this example here of the student takes out loans. Basically, it's for living expenses for the most part. And I can tell you that, and I know that, and I'll tell you why in a second. $4,000 we received in Pell Grants, $2,500 scholarship, so we have lots of money. Now, how much did the school cost? How much did my books cost? I can actually figure that up once I know how much Ivy Tech refunds to me. The easiest thing to do when you are given information like this, so the main information is how much money did you pay in through loans or out of pocket, plus how much free money did you get, and then subtract out your refunds. All right, let's work through this. You add up all the payments. So 6,000 plus the 4 plus the 2,500. Ivy Tech was paid 12,500 this semester through all of these various means. And then if we subtract our refund, that tells me that Ivy Tech kept $5,300. They kept $5,300 to pay for books, tuition, anything else that I may have paid for on my account. Now the $5,300, that's what it cost me to go to school with everything, but look, I got $6,500 in free money. So that means some of this free money was actually refunded along with all of my loans. Now, it doesn't matter that my loans were refunded. What matters though is this free money. I had $6,500 in free money. It only cost me $5,300. So if I take out that free money, the $6,500, this tells me that $1,200 of that free money I got back as a refund. Therefore, it is taxable. If it is taxable, if it comes back as a negative amount in my little formula, it needs to go on line 1 of the 1040. And you're going to see that when we do a tax return later on for this week. If this number ends up being a positive, then that's the amount you're allowed to take as a potential credit. And we're going to talk about how those credits work next. But first, we got to figure out, do we have enough for a credit, or is it an actual payment situation where, taxable situation where we have to add it on to our taxable income? Okay, using this formula, go through example G for the entire 3 semesters and figure up, does this individual owe money, or not owe, but do they have to report taxable income, or is some of it going to be eligible for credits? So this will take you a few minutes. Hit pause, and then we'll go through the answer. The first thing that you want to notice with this one is, I give you the box 1098T because every student should have one. We ignore it. I don't care what it says here. We're going to go down to the itemized bill, and we're going to look at semester by semester. How much was Ivy Tech paid, minus your refund, minus how much was free money. And so let's go through that. If you add up all 3 semesters, and you can do this semester by semester or do it all in one, it's fine either way. If you added up the amount that Ivy Tech was paid, so 2,800 plus the 13 plus the 35, 8 and 15, and then these three amounts. If you add up all of these, it's 17,500 minus all three refunds. All three refunds is 7,700. So that tells me for the year, the tuition and books was $9,800. Now, if I go through and add up just the free money, so that means the Pell Grants, that means these three things here. The O'Bannon Grant and the Ivy Tech Scholarship, I add up all three of those. That's how much free money I had. So Ivy Tech billed me $9,800 essentially. I had $9,000 in free money. Therefore, free money didn't cover every single dollar of my tuition. So I don't have to add anything to my taxable income. I actually had to pay a little bit. It came out of my loans, so I didn't really notice that I paid it, but I got back $800 less of a refund than if this would have simply been $9,800 and covered everything. So in the next section that we get to, I could have used $800 as a potential credit, depending on which education item I qualify for. Okay, so here's the primary two for the years 2018 and beyond: the American Opportunity Credit and the Lifetime Learning Credit. The American Opportunity Credit is by far the better option if you can take it. The Lifetime Learning Credit is decent, but it's not nearly as good. All right, so for both credits, you've had to have paid for this tax year, or you paid this year for the first part of next year. So if you paid in December for spring classes, that's still okay. You can still take that as a deduction. You're allowed to take as a payment for anything you pay for yourself, spouse, or any dependents. So as long as you claim your children on your return, you're allowed to take that as a potential credit. Notice here, students cannot claim this credit if they are claimed as a dependent. If you are a dependent, then your parents are the only ones that can claim the credit. If someone other than the student or parent pays the tuition, it is deemed that it is paid by the student. So if the uncle pays some of your bill, you can count that as your own payment, as yourself, if that happens. Okay, for the American Opportunity Credit, this is the much better one, and you're going to see why. And it's because not only do you get tuition as coverage, but any books that you spend or equipment. So that means like if you had to buy a computer or software or maybe even a printer to help you do your schoolwork, that counts as education expenses, and you can use that as part of your credit opportunity. With the other one, with the Lifetime Learning Credit, you can only take tuition, and that's about it. Now, the American Opportunity Credit doesn't allow normal room and board. That's pretty typical. That's not part of the actual education. Some of the rules, though, with the American Opportunity: you can only use this as an undergrad student, your first 4 years, that's it. You have to be at least a half part-time student, at least a half a load. And you have to be a degree-seeking student, so you can't be just taking a few classes here and there. That doesn't count. You have to be a degree-seeking student, at least a half load. And then here's how the credit is played out. If you meet those simple qualifications, the first $2,000 that you spend, tuition, books, computers, whatever it is, you get to take dollar for dollar off on your taxes. Now, this education credit, it starts out on Schedule 3. They're on line 50 as Form 8863. You're going to fill out the education piece. Now remember, this is a non-refundable credit up to a point. So you can't take everything. You can only take as much as your tax liability is up to. Once you get to 0, then you're done. Except for this piece down here. This is why this one is so much better than the other one as well, is because at least 40% of your education credit can be refundable, take you more than zero, and you actually get refunds back. Now there is a phase out. It's somewhat high, but not terribly high if you're a well-to-do family. So it's kind of there in the middle, not extreme high like the child tax credit of $400,000, but not really low either. All right, so when I mention here 40% of the credit is refundable, the good news is the amount of refundable credit is taken first. So if you fill out Form 8863, and that's on page 9-12, you're going to take that first, and then whatever's left, you take as a non-deductible credit there on Schedule 3. All right, let's look at example H, looking at the American Opportunity Credit. So you're going to want to have page 9-12 up and available. So we'll go ahead and turn to that. We have a tax liability before any credits of $500, so not very much. We're kind of limited then on how much refund we're allowed to take because we can only go up to $500. AGI is $40,000, married filing joint. All right, tuition and books $3,000, laptop is $600. We had Pell Grants for $2,500 of our tuition, and then the rest is paid for out of pocket. Student is at least part-time and in the first 4 years of school. How much credit can they take? All right, the first step we have to do is figure out how much in allowed education expenses did they have. So if we look here, total bill would have been $3,600. They received $2,500 as free money. So that takes 36 minus 25. That means $1,100 we ended up having to pay for through loans or out of pocket. $1,100. And that's what I have here. Now where we need to do is looking at Form 8863. We've got to figure out how much of that $1,100 can I take. All right. So using Form 8863, we need to take, well, on the 1040, it's line 17C is that refundable credit. But if you would go through and fill out 8863, and I'm not going to spend the whole time going through this, but at the very top, if you go through the top portion first and you get to line 8, you take 40% of the $1,100. That's there wasn't any, we didn't hit any phase outs, nothing weird happened. So the first $440 goes to line 17C on the 1040. And then what's left, the $660, if I take the $1,100 that I'm allowed minus the $440 that I just took as a refundable, I still have $660 I could possibly take, but I only had $500 in tax liability. Therefore, if I only have $500 in tax liability, I can only take $500 of the remaining credit. So I'm gonna lose out on $160, but I get to take quite a bit of the $1,100, almost all of it, dollar for dollar as a credit. All right, try example L and see how you do, or example I should say. All right, with example I, notice they didn't get any free money. The amount that they're actually going to be billed for is $4,400. Now, one thing that I kind of skipped past, you're allowed to take up to $2,500 of a credit for each individual student. Remember I said the first $2,000 you get dollar for dollar. The next $2,000 that you pay, you only get a quarter out of every dollar. So when I come down here to I have $4,400 in expenses. I have to stop it at the first $4,000. I can't take any more than $4,000 as eligible expenses. Okay, so $4,000, I can take dollar for dollar of the first $2,000 and then 25 cents on the dollar for the next $2,000. Students at least part-time and in the first 4 years of school. All right, so let's go through this. So this is what I was just talking about, how you're allowed dollar for dollar and then a portion, a quarter of the next 2,000. So we're allowed $2,500 potentially if we didn't have any phase out implications, but our AGI is quite high. If we go up here to the AGI, you can see that we are in the middle of it. So we need to do the phase out calculation. Remember, you take the top, you take your number minus the bottom number. Actually, sorry, let me rephrase that. You take the, as I was saying before, you take the top number of the phase out, subtract out the AGI, so that leaves us with 12,000, and then you divide it by the span. There's a $20,000 span here. So if you do the calculation, this is 12,000 left. 12 over 20 is 60%. We're allowed 60% of the 2,500 total that I would have normally been allowed to take. Now we go through the 8863. The first 40% is refundable, so that's great. We get $600 refundable. The rest up to 900, so 15 minus the 600 that I just took, up to 900 could be used as a non-refundable, and I've got plenty of room for that. The remainder of 900, because it told us in the example that I had total tax liability was 9,000, so I can definitely take 900 away and not have any problem. Now with example J, the key difference here is we have more than one kid. Each kid is allowed $2,500 or $4,000 in total expenses. So I have to do each kid separately. I tell us what the expenses are for child 1, and then the expenses for child 2. Obviously, child 2 is going to be cut off. Both are at least part-time in their first 4 years. And the tax liability is $3,000 before any credits. AGI is not going to come into play because married filing joint, they're not up to 160. So for child 1, we're allowed to take dollar for dollar the first 2,000, and then 25 cents on the dollar for the next 2,000. So that's only another 100 here. So that person would be allowed 2,025 for kid 1. For kid 2, we have to stop it after $4,000, so they're allowed 100% of the first 2,000, 25% of the next 2. So they're allowed $2,500 for that student. Total possible $4,525 for the education credit. How much is refundable? This is not line 68. This should be line 17C of the 1040. 1810, non-refundable piece. So we have $4,525 total possible. We take out the first 1810, so we're left with $2,715. We can take it all because remember our tax bill was $3,000. We can take off all $2,715 as a non-refundable because it doesn't quite get us to that $3,000 mark. Lifetime learning credit. Lifetime learning, as I said, is only for the tuition and fees. But the good part is, so no books, no equipment. The good part is you don't have to be a degree-seeking student. You can just take classes one at a time. You can even be taking graduate or doctorate level classes. Doesn't matter. It doesn't have to be in your first 4 years. What you're allowed to do is up to the first $10,000 in expenses, you can take 20% as a credit. So therefore, you can see the most you can possibly take is $2,000 per year. So if you spent $2,000 on education expenses, you could take 20% of that, so $400. Notice the phase out is smaller, is lower than the American Opportunity Tax Credit. So you got to keep that in mind as well. All right, retirement contributions. I'm going to skip through this. You can read through this. It's a very low amount. Not very many people can take it. If you look at page 9-18, you're going to see the chart. I'll look at that real quickly. Look at page 9-18. The chart shows that if you're in a joint return and you have under $63,000 for your modified adjusted gross income, then you can take a 10% credit of whatever you put aside for retirement. It's not that much. Or if you're single, notice the amount. If you make over $31,500, which isn't that much, you don't get to take any type of retirement credit. So that's why I don't spend a lot of time on this. It is there, but it's mainly for the low income. And a few of the other qualifiers, you cannot be a full-time student and you cannot be a dependent and able to take this credit. Okay, we've talked about 2 of the refundable credits. We talked about the American Opportunity Tax Credit, the refundable piece, and the additional child tax credit. The last big one is the earned income credit. Earned income credit, as you can see here, it's designed for the working poor and for those especially with children. The more kids you have, up to 3, the more you're going to get back as an earned income credit if you're in the right income brackets. If you have more than 3 kids, then it doesn't matter how many you have to stop at 3. The income limits, if you look at page 9-32, it gives you some charts on how much earned income credit you can expect. But what we're going to look at is what I think is, it's harder to understand at first, but once you get used to the chart, it's not that bad. If you look at page 9-24, 9-24 gives us a table that will help us to figure out how much earned income credit an individual is allowed depending on the number of kids they have. And then what I consider, and what you're going to hear me say, the Goldilocks zone. If you are in the Goldilocks zone, that's for people, look at the number of kids that you may have. So let's say you're at the 2-kid item. You look at the dollar amount over for earned income up to. So that's that second line down. You have the EIC percentage, then earned income up to. If you make over that amount, but under the phase out, depending on which one you are, joint or other, so 24 or 18, you're in the Goldilocks zone. That means you're going to get the absolute most earned income credit that you can possibly get. If you're under the 14, you're going to be limited because you didn't have enough earned income. If you have over the 24 or the 18, you're going to be starting to be capped and phased out. So I'm going to go through this practice a couple, and then you can look through the remaining examples and see how you do. I'll put the answers up. So let's work through and see how this table works. With practice 1, we have 18,000 earned income for an individual who is single with 3 kids. All right, so this individual falls within that Goldilocks zone. Income's above 14,290 and below 18,660. So there's not a lot of range in there, $4,000 range or so, but we are in that. We are able to take up to 45% of the max amount of our income as a credit, and then we can't go over the max. So you can see the third line down in the table, it says maximum EIC. That's the absolute most we can take. So let's go through 14,000. If you want to see where they came up with the max of 6431, basically they took that for earned income up to. They said this is the most you can take. We'll give you 45% back as a refund. Our individual case was at 18,000. We still don't hit the other cap. We're not starting to be phased out, so we get all 6431. We don't quite get to take the 8,100, but we're not going to have to take away any money either. We still get the full max amount of 6431. Now let's look at one that does start to look at the phase out and see how that works. So this one didn't. We got the full up to the maximum amount. Same situation, except now we have 24,000 earned income instead of 18 for a person with single with 3 kids. Okay, so the first thing we have to do, since we're over the 18,660, we've got to find how much are we over the 18,660. That's the first thing we got to do when we're in that phase out range. Okay, we're over by 5340. What we then have to do is look down to line 4 on the table, or no, row 4 on the table. It says phase out percentage of 21.06. So the amount that we're over, we have to take that by 21.06, and that's the amount we have to take off of our max. So up here, our max was 6431. We are beginning in the phase out. We can't take 1125 of this amount. So we take the 6431 minus, I didn't update this, minus 1125. And we get the 5239. Let me make sure that that is correct. I think I just didn't get that one number updated. So 6431 minus 1125, oh, no, 5306. There we go. That's how much earned income credit we would be allowed because we began to hit that phase out. All right, go through at this point L and M. We'll go through L and M at the same time, and then we'll go through N and O at the same time. So hit pause and practice L and M, and then we'll go through the answers. All right, with L, we hit the max. We're married filing joint with 2 kids. The max where the phase out starts is at 24,000. We make 33. So we do hit the max. We got to figure out how much over the max of the 24,000 are we. We're over by 8,650, and we got to multiply that by the phase out percentage, 21.06. And then whatever the max is for that number of kids, it tells us there in the chart, 5716. We have to take away this dollar amount. So the amount left for earned income credit in example L is $38.94. If you need to redo M, go ahead and pause now. Otherwise, I'm going to go on to N. All right, with M, again, we begin to hit the phase out. We got to figure out how much are we at the phase out. We are over it by this dollar amount here. I didn't do all of the calculations, so basically I took the difference here and multiplied it by 0.2106, giving me this. So the amount that we're allowed with the 3 kids is $4,043. All right, using that, go ahead and finish out N and O. N and O, especially O, has a little bit different because we are under the for earned income up to. All right, for example, N, we did not hit the phase out. So we're allowed to take the lower of whatever we calculate, the 34% for 1 kid, or the max credit. Well, the max credit is the lower of the 2. So we're allowed to take 3461 instead of the 5100. And then notice for O, we made 10,000. We can take 10,000 times what it is for 2 kids, 40%. We don't even hit the max. The lower of us or the max is us, which is $4,000. Notice the rule here, if you have no kids. If you have no kids, the amount is severely limited. And you have a couple other criterias. You have to be working and at least 25 years old, less than 65, and not claimed as a dependent. Notice these maxes here. As you can see, they go down a little bit for each having less and less kids, all the way when you have 0 kids, look how much of a drop it takes. So basically, it's for people who work with kids. All right, you can go through the review. This may help you determine what is your dependency exemption, taxpayer filing status, Who can take the child tax credit? I think it may be good for us to go through these. This should actually be P and Q. I've had to rearrange these over with the new tax law updates, so I had to redo things. What I want us to be able to do here is determine who can claim the dependencies, what's the filing status, and who's going to get the child tax credit and the EIC. Actually, there is no such thing as dependency exemptions. We'll take that out because we don't have those anymore. Taxpayer filing status, child tax credit opportunity, and I'm going to put here or dependent. Oops. Dependent or dependent credit. I think that'll be good enough. And EIC opportunity. With P, taxpayer example P here, we have 15,000 earned income and 100% support for the boyfriend who has only 2,000 of income, and the boyfriend's son who is 6 and lives with the taxpayer. Boyfriend files a return, doesn't claim himself, only to get back a refund, and doesn't claim his child. Boyfriend hopes that the taxpayer can claim the child and all the benefits that go along with it. All right, since the boyfriend, since we provide 100% of support for the boyfriend lives with us, and he makes under the $4,150 income test, we can claim the boyfriend, and then therefore we can also claim his son because he only files a return because to get his refund, he doesn't have to. He makes way under the threshold. In that situation, the taxpayer can claim the boyfriend and the boyfriend's son. However, we cannot claim head of household because they are not related to us. So the taxpayer would have to file a single. Can she claim the child tax credit? Nope, she can't, but she can claim the dependent credit. And for the EIC, oops, let's go back up here to P. The EIC, no, can't do that because it's not your qualifying child. It's only a dependent. So the answer would be no. But she can claim, I'll fix this up for the answers that you see later on. If you want to pull those up, I'll have this better typed out. For example Q, with this situation, 3 generations live together, grandma and grandpa, and then mom is separated and will not file a joint return. Very low income, and the daughter. Mom does not need to file. Mom and child live with grandparents 9 months of the year and were supported by the grandparents. Separated spouse, father states he will claim the 3-year-old child. Ooh, this could be very touchy here. The father actually can't claim the kid unless there is a divorce agreement or a separation agreement. It doesn't appear that there would be. They're still married. If they had a separation agreement, there could be that chance that he could still claim the child and get the child tax credit. Without it, he's not allowed to take the credit. He didn't live with the kid for at least half the year. So grandparents can claim both the mom and the kid. The grandparents can claim the child tax credit because it is their qualifying child. They can also claim the earned income credit. The dad would not, if he ever got challenged, he would not be able to claim the child. He would have to take it back off. Okay, some final examples to practice from the book. I think these would be good ones to help, and I'll have those answers here attached to our in-class answers as well. With that, I know this was a little bit longer, but we will say goodbye, and I will begin to do a recording for the tax return.